Hello and welcome to the Small Business Briefing. I'm Brian Calley, CEO of the Small Business Association of Michigan.
Hi, everyone. I'm Sarah Miller, Vice President of Marketing and Strategic Communications at SBAM. Thanks for joining us today. I also want to say thank you to our sponsor, SBAM Energy Solutions. SBAM Energy Solutions is a partnership with Consumers Energy and DTE Energy, which provides enhanced energy services to small businesses across Michigan. So let's dive into the show. We have quite a few topics to cover. Brian, you recently spoke with Cranes Detroit about the implications of a new Facebook survey on small business closures.
Yeah, this was one that, so there's a lot of organizations that have interaction with small business. Social media is one of them, Facebook, that has a business platform, a small business platform. And so they did a survey and found that Michigan was tied for the most small business closures this year, and it was at 28%. Now, 28%. What is that? That probably sounds high. It is high. Now, I wouldn't expect that would be representative of the small business community. In fact, I can tell you for sure that it's not. The types of companies that primarily use social media as their sales channel, as their of marketing or advertising, where they make connections. A lot of them are going to tend to be smaller and startup type companies, and so you would naturally see a higher failure rate with that particular cohort. Still, the fact that Michigan was relatively higher than most other states, I think, was also concerning. And one of the things where we've seen a lot of crosswinds out there in terms of economic data, but as of late, it really does seem like there's more and more piling up that give the impression that tougher recessionary times are in our future here, at least in the immediate future. So not particularly good or not good news at all, but I think also probably overstates the business failure rate if you were to look at second stage companies and later stage companies that probably are not as included in the social media survey.
Another survey was recently released from KPMG, and that survey was of CEOs and also reported out on recession expectations.
Yeah, what they do regularly is ask CEOs. So we're not talking about small businesses here. We're talking about generally larger company CEOs, and they're the types of companies that do forecasts for their sales. So they do these economic forecasts, and so it's pretty insightful when you ask them what they expect to happen in the future, because you're kind of getting insight from a lot of different companies that operate all over the world that have a lot of different economic models to forecast their own sales and activities for the future. And more than 4 out of 5 so that they do expect that we are headed into recessionary times. About 2/3 of those, though, that expect a recession, so they expect a mild and short recession, which I think would actually line up with kind of the overall investor sentiment out there today, which is that this transition with all the things that are being done to get inflation under control, and just the transition time, shortage in people, and supply chain issues that we've got. That we do have some tough economic times here upon us, but I also think that there's an expectation that the underlying fundamentals are actually still pretty solid. It's not like a 2008, 2009 time period where there's an overarching concern that the bottom's going to fall out. But doesn't mean it will be easy, and also doesn't mean that the CEO expectations and forecasts are correct. But there seems to be a pretty wide expectation that the forecasts are, or that we're headed for recession, but it'll be a milder and shorter recession certainly than what we faced 10 years ago, or I guess was it been 13 or 14 years ago in the Great Recession.
Now, I noticed on my way into work today that gas prices have continued to creep up. Kind of took note, like, oh yeah, that's back to where it was. So what's that telling us?
Yeah, and there's, inflation had seemed like it was kind of leveling off, but you might remember a few weeks ago when we were looking at core inflation versus headline inflation. And headline inflation includes all of the commodities, things like gasoline. Core inflation are the things that move up slower, but they also are hard to get to come down. So we saw two things happening. Headline inflation was coming down a little bit, but core inflation was still going up, and so it was kind of a mixed signal. One of the big reasons why headline inflation was coming down before is because there was a trend for a couple of months of gas prices coming down or oil prices going down. That has definitely turned around now, and we see pretty substantial upswing in those prices, which is going to again create some upward pressure on prices and rising costs or inflation. And so when I look at what's happening with respect to fuel, which kind of finds its way into costs of pretty much everything, that's one of those things that could really set back the inflation, the hopes for a quicker reduction in inflation rates. So it's one of those things that's kind of pushing against what the Feds are trying to do, rising gas prices. So there's we could do a whole nother story on what's happening out there in the oil markets that are contributing to that. But certainly that there are production issues in other countries that have an interest in higher prices, and so have made very public decisions that they're going to scale back on production in order to push the price up or not let it fall any further. So that really did seem to send a message to the market that has reversed the decline. And here's the thing: is even though it felt like it had gone down a lot, and it had gone down a lot, it was still high before it turned around and started going up again. So that's it's just one of those forces that I think that continues to create that upward pressure on the overall headline inflation.
All right. In other economic news, the stock market had losses 3 quarters in a row, I believe. And this September was the worst month since March of 2020.
Yeah, so September ended up being a horrendous month for investors. But what's happening is that there's mounting evidence that tough economic times are coming in our future, and investors it's making investors skittish. So it looked like for a little while there that there was maybe some upward momentum, some recovery starting after the first 2 quarters of a slide, and then it really did drop off to create new lows for this year. And in the month of September ended up being a pretty horrible month for investors, for equities we're talking about here. And you have to go all the way back to March of 2020 when there was a big drop with the start of the pandemic, and nobody knew it was going to happen, and the business closures and all those things that were happening. Then there was a pretty big decline. The September decline actually is the biggest since then, and there's been a lot of declines all year. So it's really saying a lot this far into this year, and after this many declines, that September was the worst. But I want to underscore though that the stock market is not the economy. These two things do not just move in tandem. They're not. They do sometimes move in tandem, but they're not the same thing. A crash in the stock market is not the same thing as a recession, but it is the sort of thing that can change consumer sentiment. You see the value and your net worth declining as much as it has, 20 and 30% this year, depending on what types of equities that you're invested in. It doesn't do a lot to bolster consumer confidence in the future, and it can be kind of it can be a self-fulfilling prophecy when people start to pull back because they're feeling less comfortable, less confident in the future, that it actually contributes to rougher economic times. But these are the types of cycles that we experience. So between rising gas prices and a skittish investor market and pretty substantial declines, starting to feel a lot like headwinds.
All right, let's shift gears a little bit. You've speculated a few times about national politics and whether or not President Biden would run for re-election, but the White House has confirmed that that is his intention.
Yeah, so they said very directly. I think they're really concerned about being written off or kind of getting lame duck status too early, and so answered directly that he's planning to run for re-election. I don't necessarily think that means that he will. I think they had to say something because people were starting to kind of look past. When the independent pollsters start polling 2024 nominees and they leave the current president off it, all of a sudden that's sending messages to the general public in a pretty regular way that the people have a tendency to look past the person whose time is coming to an end or has a terminal date on their time in service or time in office, and so I think that they just want to desperately put off that lame duck status as long as they can. So the announcement of the directness of the answer to the question was more so than what I think usually at this stage you're not so directly talking about re-election or not even through the midterm elections yet. But I think in this case they felt like they had to say something or else the system was starting to move past this presidency sooner than they were comfortable letting that happen.
So earlier this year, we talked about the Growing My Business Grant Program, formerly known as the Afflicted Business Grant Program. And Treasury recently released a new report on the outcome there.
Yeah, they put out the data just on what happened with the grant program. This is one that we had supported that was aimed at those industries that were closed down the longest, including like the entertainment industry. I think there was an expectation that there wouldn't be enough money, and so they put a lot of restrictions on it. What I would hope would be an unintended consequence is that most of the applications that were made actually didn't end up qualifying for any payout. You could get up to $5 million. The ones that were able to get the maximum were the casinos in Detroit. So definitely not small businesses, but the Afflicted Business Grant wasn't just limited to small businesses. It was limited to industries. And a lot of those industries are dominated by small businesses, but casinos were one of those that were closed down for a long time or restricted for a long time. So they qualified and got the max payouts. But there was over 400 million allocated, and only 117 million was paid out. So the rest of that is still remaining, and it's not exactly clear whether will that money just lapse back. Are they going to do another tranche, maybe change the criteria a bit? But in terms of sheer numbers, it was 2,981 businesses that qualified at least for something. The highest, remember I mentioned the Detroit casinos, because they had, as listed, everybody who got it, were the highest at 5 million each. And then all the way down to one business that qualified ended up qualifying for $2. So but there were 5,333 businesses that applied and did not get approved. So obviously there was plenty of need, but the criteria for the program ruled out most of the applicants from receiving anything from it. So this kind of be an item added to our to-do list, which is okay. There's a lot of horsepower that is put toward helping the businesses that were impacted the greatest. What was wrong with that criteria that kept most out, and what then can we do now in order to make sure that we achieve the intended consequence of the program in the first place.
Absolutely. I hadn't seen the $2 grant on there, so that's, yeah, not so helpful. Let's talk about battery plants. I feel like I've seen lots of headlines recently about battery plants here in Michigan. What's the latest?
There's an economic development fund that was created at the end of last year. Legislature puts money in it. The Michigan Economic Development Corporation and the governor can try to sell Michigan to companies that are looking to locate big kind of transformative operations in different places, and so electric vehicle and electric engine manufacturing has been like the main focus. And the legislature just did put additional money in what's called the SOAR fund, which is the economic development fund, where these awards come from. And so while they approved already two electric vehicle manufacturing operations, two more were just approved, and the two new ones being in Livonia and Big Rapids. Should end up being about $4 billion in additional investment. But if you were to add up all of these different electric vehicle components, like 7,300 jobs, and you might say, well, that's sounds great. I think that there is some things to keep in mind on this, because while it makes sense for Michigan, the kind of the center of the world for the automotive industry, at least of North America, it makes sense to try to keep and get the next generation locked down for Michigan. But we can't really go back to that one-trick pony type of an approach to economic development. So in the 1990s, there was some success using economic development programs, and through the early 2000s in getting in kind of keeping and holding on to that automotive base. But when the global market for automobiles fell substantially, Michigan, of course, was hurt a lot more. And so it's important. Like, there was this mantra of diversify Michigan's economy for a long time. That's what we're all about, right? Small businesses. We've got 30,000 members in every community, in every industry you can think of. There's a certain resiliency to the economy that comes from not having all your eggs in one basket. And I think if there's one kind of overarching message is, yeah, we understand and it makes sense that we want to get the next generation, but it can't just be that, just the next generation of automobiles and mobility. We really have to have a diversified strategy that makes Michigan a great place to start and grow a business. And when you do that, when it's the place where entrepreneurs can be successful, or to succeed or fail based on the merits of their own idea and their own hard work, then you're adding in a resiliency to the economy, a stronger economy than based on one thing, where it's great when automotive sales are soaring, and we really get killed when automotive sales are down. Like, to go back into that cycle in a more robust way, it's a pretty risky proposition. And so as we look forward to a new legislative session and where our agenda moves, I think it's not about stopping economic development programs like the ones that are landing these battery plants, but making sure that the state sees the economy as with a much wider lens than just that. And if we can really create an environment around the success of Michigan small business, then we'll be in a position where incentives won't be as important to our world as they appear to be today.
One last thing before we say goodbye for the week. Next Thursday, Brian's actually presenting a webinar in partnership with our friends at DTE Energy. Brian, you're going to talk a little bit about economic challenges and maybe preview what 2023 might look like for small businesses. So you're all invited to join us. You can register at sbam.org/events. Until we see you, we'll see you Monday. Have a great rest of the week.
Thanks, everybody. See you next week.